me here, you'll never be lonely. It's oh so clear, I've always been falling through a life that's upside down. Somehow you turn me around.
What is Forex trading? Forex trading, also known as FX trading or currency trading, refers to buying and selling of international currency pairs. The main aim of Forex trading is to exchange one currency with another in the expectation that the prices would alter, that is, the currency bought shall appreciate by value with the one sold. Forex market is the largest financial market globally, where the investors, speculators, and corporates are involved in cross-border Forex trade. Unlike other financial markets, the Forex markets do not operate through a physical location but via an electronic network of corporations, banks and individuals, trading one currency for another. This makes it convenient for Forex markets to operate 24 hours round the clock across time zones and financial centers for 5 days a week. How to make money on Forex? As Forex markets are the most liquid markets with easy access round the clock and low costs, many currency traders take a quick plunge into the market, but then exit even more quickly after experiencing setbacks. Here are a few pointers for investors, traders to keep up with the competition and on how to make money on Forex. Learn the basics of Forex trading. Learning the basics of Forex trading ranges from acquiring knowledge of the operative terminology to acclimatizing with the geopolitical, economic factors affecting the trader's chosen currencies. To master and make money on Forex trading, being well informed of the following operative terms is essential. Currency pairs. Currencies are always traded in pairs, such as JPY, INR, USD, GBP, etc. There are three types of currency pairs: major pairs that always involves USD, US dollar, that is, USD, EUR, USD, INR, etc. Minor pairs that do not involve USD but peg major currencies against each other, that is, JPY, EUR, EUR, GBP, INR, JPY, etc. Exotic pairs that include one major currency and one minor currency like USD, HKD, US dollar, Hong Kong dollar. PIP, point in price. A PIP is a difference in the valuations of the currency pair. For instance, if the USD INR rate is 74.7001 today and was 74.7002 yesterday, then the PIP is 0.0001. Base currency and quote currency. The currency mentioned on the left side in a currency pair is the base currency, and the one on the right is called the counter or quote currency. The base currency is always the reference element and has a value of 1, and it indicates the amount of quote currency required to buy a unit of the base currency. For instance, if you buy EUR, USD, it means you are buying the base currency while selling the quote currency. In simple terms, a trader would buy a pair if she believes that the base currency shall appreciate relative to the quote currency. Contrarily, the trader would sell if she believes the base currency shall depreciate with the quote currency. Bid and ask price. The price for buying base currency is bid price and the price for selling base currency is the ask price. For instance, if USD INR is quoted as 75.7260, 75.7240, then the bid price to buy one United States dollar would be 75.7260 rupees. 75.7240, and the ask price to sell one United States dollar is Rs. Spread. It is the difference between the bid and ask price. Lots. Currency trading takes place in lots, and three types of lot sizes are available based on the units: micro, 1K units; mini, 10K units; and standard, 1 lakh units. In addition to these operative terms, researching and studying Forex markets is always a work in progress, and the traders need to be prepared to adapt to changing market scenarios and world occurrences. Developing a robust trading plan to scrutinize and examine investment options based on the risk appetite, in line with investment objectives, shall be a systematic way to make money through Forex trading. Forex trading, also known as currency trading or FX trading, is the act of buying and selling international currency pairs. Its primary aim is to exchange one currency with another, in the hope that the value of the currency purchased will increase relative to the one sold. The Forex market is the largest financial market globally, where investors, speculators, and corporates partake in cross-border Forex trade. Unlike other financial markets, Forex markets don't operate physically, but through an electronic network of corporations, banks, and individuals who trade one currency for another. This convenient setup allows Forex markets to operate continuously for 5 days a week, 24 hours a day, across various time zones and financial centers. Forex markets are the most liquid markets with easy access 24/7 and low costs. However, many currency traders make a quick entrance into the market but exit just as quickly after encountering setbacks. To keep up with the competition and earn money in Forex, traders must learn the basics of Forex trading, from the operative terminology to the geopolitical and economic factors affecting their chosen currencies. To master and make money on Forex trading, it's essential to be well informed about the following operative terms. Currency pairs. Currencies are traded in pairs such as USD, GBP, JPY, INR, etc. There are 3 types of currency pairs: major pairs, which always involve the USD, minor pairs, which don't involve the USD but peg major currencies against each other, and exotic pairs, which include one major and one minor currency. PIP, point in price. A PIP is the difference in the valuation of the currency pair. For instance, if the USD INR rate is 74.7001 today and was 74.7002 yesterday, then the PIP is 0.0001. Base currency and quote currency. The currency on the left side of in a currency pair is the base currency, and the one on the right is called the counter or quote currency. The base currency always has a value of 1 and serves as the reference element, indicating the amount of quote currency required to buy a unit of the base currency. Bid and ask price. The bid price is the price for buying the base currency, while the ask price is the price for selling the base currency. Spread, the difference between the bid and ask price. In simple terms, a trader would buy a pair if they believe the base currency will appreciate relative to the quote currency. Conversely, they would sell if they believe the base currency will depreciate with the quote currency. To make money on Forex, traders must be willing to learn, stay informed and consistently apply the knowledge acquired. Thanks for watching. Keep following our channel for more such videos on Forex and stock trading.